Is up, everybody? We are live, and just make sure everything's working. Let's see. Let's get to the YouTube, see if that's working. And it is. Okay. Also, resume my recording. Alrighty. So today is October 29th. It's almost Halloween, and the first month of Q4 is almost over. So this is going to be a bit of a different show, and that might be a permanent change. I don't know. So, this last week, I was at FinCon 2024, and it's all about people in the finance world who create content and things like this. So, FinCon was great. I learned a lot. I met with a lot of great people, and it really helped crystallize something for me. And that is that I need to not shy away from my actual core beliefs. And so, what do I mean by that? So, there's a couple different layers to what it is that we do here at Tax Sherpa and why I founded it. So, if you've tuned into this show before, you'll have heard my story about how I went through my own entrepreneurial journeys. I ended up getting nasty letters from the IRS, and then in fixing my own problems, I fell into this whole tax world, and it's now part of my mission to help people like me, essentially small business owners, solopreneurs, independent contractors, freelancers, basically anybody who doesn't have a day job for somebody else is a good candidate for Tax Sherpa because I can go in and along with my team, we can structure things in a more tax efficient way and save tons of money. So that is the individual level of the mission. However, there's a bigger part to the mission. The bigger part is I want to defund the government. And people talk about defunding the police and everything. I want to defund the whole thing. And there are reasons for that. But fundamentally, I think the world would be a better place. Also, you know, I think people do a better job with their own money rather than handing it over to the government. So, you know, we're going to be rebranding this show instead of just being office hours. We'll still do questions and answers and everything, but I think we're going to rebrand as something like, you know, the defund the government show or something like that. Um, and a large part of that is technology, and we'll get into that a little bit later about how use technology to defund the government. So, with all that said, let's dive in. All right, so like I said, this will be a little bit of a different show than normal. Let me share my screen. Here's the whole document that I am calling How to Save $100 Billion. So I'm going to make sure that this is actually coming up on screen because I've had problems today with Zoom and the um, the share is not working quite correctly. So let's see, is this working? And yes, it is. Okay, at best. So this is how to save $100 billion. Now, that might sound um, extravagant, but I'm actually going to walk you through exactly how to do that. And it's pretty simple, but we need technology to do it. And I'll show you what I mean by that here as we go through it. So the IRS has a division called SOI, and it's these guys over here. Um, do I remember what SOI stands for? I think it's Service of Information or something like that. But you can go through and they publish all different kinds of stuff, all different kinds of reports and things. And one of the publications is publication 4801, which is it's actually a really useful publication. It's the most recent one is from tax year 2021. And what it does is it goes through the different tax return pages and it shows you the different numbers of uh, of basically what the American public filed as in total. So it'll have two versions. So like here's Schedule C's, right? Profit or loss from business. This first one that has the white border has the number of tax returns that were filed with something on those lines. So 27,592,394 tax returns were filed with something in box one up here. Hey, Serena,
Hey Neil, how are you?
doing good. I'm just
Good.
showing people how to save $100 billion.
Oh,
Uh,
awesome.
so it does this for every page in the tax return on publication 4801. And on the following page with this little, I don't know what color that would be, a greenish kind of border, um, it gives you the actual dollar amounts of all the tax returns that were filed with a Schedule C. And these numbers are in thousands. So this 1,834,086,335, that's actually, instead of being 1 billion, it's actually $1.8 trillion worth of revenue was reported on line one of Schedule C's in total of all Americans in 2021. And uh, so this is Schedule C. And there's three things that I'm looking at here of how to save $100 billion. We're looking at Schedule C's, we're looking at partnerships, and we're looking at S corporations. Those are the three business types, the primary ones. There's others, but the biggest ones that flow through into individual income um, tax returns. So if we look at that, there's actually a more detailed version of these pieces of data. Um, so there were 27 million uh, Schedule C's filed, but actually, when you look in the details, 21 million of them had profit at the end of it. And the total amount of profit was $516 billion. And if you divide that out, that's $24,490 per profitable Schedule C. Okay, so of the 21 million, you average it out, the average one made 25 grand. Okay, so that's element number one. Element number two is partnerships and S corporations. So we had roughly 11 million total that were filed, but ones with profit, because again, we're not paying, people aren't paying tax on losses, typically, anyway. We had about 3.6 million. I don't know if you can actually see this, but how do I zoom in? View, Tesla, zoom in, formats. Well, let me just do it the old-fashioned way. There we go. So 3.6 million S corps, 2.4 million partnerships that had profit, the non-passive income profit. And there's some more that had some passive income, but it's not as much. So in the 100 billion, I'm just focusing on non-passive income. And then of the amounts, 451 451 billion there, 761 billion there. Okay. So 2.4 million partnerships with active profit, 451 of profit. That's $187,000 per profitable partnership for active, anyways. And then for S corporations, similar calculations, comes out a little higher, 210,000 per profitable active S corporation. Okay, so how do we defund the government? We got to make some assumptions because we're modeling tax returns and then aggregating. So assumption number one is we're going to assume everybody's married filing a joint, which is the lowest income tax way to file for any given number of income. We're going to assume there's no overlap because if somebody had a partnership and an S corporation and a Schedule C, then their total income is going to be higher. That's going to raise them up in the brackets. That's going to make their total tax liability higher than if we assume they're all separate. And we're going to assume there's no other income, same reasoning. And these assumptions will create the minimum tax burden projections. Okay. So basically, this is the most conservative way to project these numbers. And in reality, it'll actually be way more than the 100 billion that we're talking about. So what happens? Well, in a Schedule C, there's two different types of tax that you pay. You're going to pay income tax and you're going to pay self-employment tax. And self-employment tax is the replacement for payroll tax, Social Security, and Medicare. So at 24,490, if you're married filing a joint, you're going to pay zero in income tax if that was your only income, because your standard deduction is actually going to be greater than that. However, you are going to pay self-employment tax of about $3,400. So if there's 21 million of those profitable Schedule Cs times 3460, that's $73 billion worth of tax. And that comes out to a 14.1% rate. Again, this is the most conservative way we can project these numbers. We do the same kind of math on partnerships because active partnerships also carry self-employment tax. So they actually have a 26.3% tax rate and $49,000 of tax per one of these 187,000. Now, obviously, these are averages, right? So they're going to be skewed. Some will be zero, some will be $100, some will be 10 million. But the average is 187,000. S corporation has much more advantageous tax treatment because you don't have to pay the self-employment tax. So instead of income plus self-employment tax, you're only paying income tax. And if you're wondering, yes, these numbers do factor in the qualified business income deduction. So we're not being unfair here. We're being as conservative as we can possibly be. So the partnerships or the owners of the partnerships end up paying 118 billion, and the S corporation owners end up paying 111 billion. So the total tax is $303 billion when we add up those three numbers. Okay, so that's how much, at minimum, the owners of these different business structures are paying in taxes on their 1040 tax returns. So that is the least possible amount that could be possibly pay. So the question becomes, well, how do we reduce that number? And I just picked a number that says, okay, well, if every Schedule C partnership and S corporation reduced their taxable income by $20,000, what would happen? And Serena, you tell me, can we reduce a corporation's profit by 20 grand with some tax strategy?
Of course.
Of course, all day, every day. Okay?
All day, every day.
So 20 grand is typically pretty easy from what we see. So what happens if we do that? Well, the Schedule Cs go from paying $73 billion worth of tax down to $13 billion. Partnerships go from 118 to 102, and S corporations go from 111 to 95. And that's a measly 20 grand worth of extra deductions by incorporating some tax strategy. So the new tax, if we did all that to all those different Schedule Cs, partnerships, and S corporations, it's $211 billion. And that creates a tax savings of $92 billion a year. And I rounded up to 100. So 92 is close enough to 100 for me as far as saving $100 billion from the government. And so, it's the money exists either way, right? So the real question is, which is better, right? Giving $92 billion to the government and then they spend it on whatever it is they spend it on, or, the owners of all these different things, taking that same $92 billion and spending it and investing it and doing whatever they want to do with it. Same $92 billion. Which do you think is better? And for me, all day, every day, every single time, I'd rather have the owners of the money make their own choices and spend that money in whatever way they see fit. And that's just one example of a simple change can make dramatic impact if we're able to get these tools in the hands of people all across the country. So one of the things about Tax Sherpa is that we do client services. That's great. We have our navigators group where we get together every week and talk business and tax stuff. It's a lot of fun. However, there is a real limit. So we can't do one-on-one services for everybody, which I wish we could, but it's just not possible. But what we can do is we can make technology available to everybody because we can reproduce that at pretty much free. So and we can start to show people how to use some of these tax strategies in their own business and start to achieve their own tax savings. So and this is like coming up with $20,000 of extra deductions is like the most basic thing that we do in tax strategy. There's lots more. Taking Schedule Cs, converting them to S corporations. uh, compensation optimization, retirement plans, all different kinds of things that we can do. When it comes to tax strategy, there's hundreds, maybe thousands of strategies out there, and this is just federal, right? So we're not even talking about the state. Um, but if you live in a state with income tax, then obviously that is going to be an additional amount on top of that $92 billion. And most states do have an income tax. Okay. Now, what do I mean when I talk about technology? Well, I've been getting into AI coding a bit lately. So I'm going to show you some things that are still in testing. So here's a very simple calculator that I've been working on. The IRS just announced the new tax brackets last week, and you can put in your income. So um, let's take one of these numbers, right? Let's take 210,120. Okay, 210,120. And if you're married filing jointly, uh, you can press this button. It's going to tell you how much you're going to pay in federal income tax 2024 and then federal income tax 2025 with the new brackets. Um, However, you can also put in a number for 2025. So, okay, I made 210 last year. And remember, all these numbers are from 2021. So I made 210 last year. Let's say I'm going to make a little bit more this year. Let's say 225. And I can click calculate, and we're going to see the changes, right? So in 2024, if I made 210, if that was my AGI, my standard deduction is 29.2 because of married filing joint. Taxable is 180, tax liability is 29.9. If we make the same amount in 2025, the standard deduction goes up, the brackets change, and instead of 29.9, I actually pay 29.4. So that actually goes down by 1.5%. But numbers of revenue is never going to be the same. If we're experiencing this inflation, typically your revenue is going to be affected as well, and your net profit is going to be affected. So it should go up over time. So if we made 225 next year, $30,000 standard deduction, 195 taxable income. Now my tax liability is 32,000, which is an increase of 9.4%. So, this is one little tool that starts to give you an idea of what it is that you're actually looking at from a tax perspective. And this was all coded by AI. So I talked to the AI and I gave it the data as far as like the brackets and everything, and it was able to produce this, which is amazing. So, and here's a second tool that I was working on last week in between going to conferences and stuff. Standard versus itemized, and this is for 2025. So let's say I got my $225,000, right? Let's hope this actually works because that'd be embarrassing if it doesn't. So, how much should I spend in medical expenses? So standard versus itemized is going to be your itemized deductions are expenses that you can deduct against your other income. However, you get a standard deduction. So you always want to do this comparison. It's like, well, are my itemized, if I list out each of my individual expenses that qualify, are they greater than the standard? If yes, I'll take the itemized. If they're less than the standard, you just take the standard. So this tool will help you figure out, what you're looking at there. So let's say I spend 15 grand in medical expenses, had some, decent sized medical expenses. State and local taxes, that's going to be your state income tax. It's going to be your property taxes. It's going to be your vehicle registration fees, stuff like that. There are limits to that as far as how much you can deduct. But let's say you live in New Jersey and your real estate taxes are 20 grand because they have the highest property taxes in the country. Mortgage interest, this is interest on a mortgage, at least interest on mortgages where the balance is less than $750,000. And so let's say, I don't know, let's say I spend 15 grand in mortgage interest. Charitable contributions, well, let's do 5,000. Say I'm pretty charitable. Disaster losses, well, in this year, we're going to see a lot of disaster losses for anybody like in North Carolina that was hit by the hurricanes. And one of the changes in the itemized deductions from the Tax Cut and Jobs Act was that casualty losses like flooding and things like that had to be in a federally declared disaster area. So before 2017, you're able to deduct them, even if it was just, oh, a pipe broke in my house, it flooded my basement, I had to spend 20 grand on repairs. That was a casualty loss. Now that only counts if you're also in a federally declared disaster area, which I am this year. So that's a fun one. Spending 30 grand on basement repair. So, there's that.
What?
Yeah, it's crazy. But don't want to live with mold. So there's that. Um, Gambling income is not a deduction, but if you have gambling losses, they are only deductible up to the amount of gambling income that you have. So let's say I won nothing, but I lost 5 grand. You'll see when it prints it out that that does not count for anything. Well, let's go ahead and calculate. Okay, so my standard, because I'm married filing joint, is 30,000. Medical expenses after the 7.5% floor, zero. Say, but wait a minute, I had $15,000 worth of medical expenses. Doesn't matter, because the way they count it is medical only begins to count if it's above 7.5% of your adjusted gross income. So in this case, the 15,000 wasn't enough to even start counting. My state and local taxes after the SALT cap, SALT stands for state and local taxes, is 10 grand. So I had $20,000 worth of expenses, but I only get 10 because those are just the rules. Mortgage interest, I get the whole amount. Charitable contributions, 5,000. And so in this case, my standard and my itemized both came out to 30,000. And so you would just take the standard deduction. Now you'll notice the gambling losses is zero because I had no gambling income. So if I change this to 5,000, now all of a sudden those gambling losses count because I had gambling income to count against it. And you have to keep in mind that this gambling income has to be part of this gross income up here. But let's say I'm very charitable. So like there's a tax strategy where we can create massive charitable deductions. So under the current rules, you're allowed to create charitable contributions up to 60% of your adjusted gross income. So now, like if we had an income of 225,000, that could be $135,000 worth of charitable contributions. And then our total itemized would go up to 160 grand. So obviously you would take that over the 30. So, these are just two very simple tools that I was able to create last week. And again, they're still in testing. I haven't 100% tried every different scenario, but I'm pretty sure that they work. And this is the kind of thing where we can distribute this, to everybody, and people can start to play with their own numbers and start to get an understanding of how things work, basically. So let's say, let's just take this calculator, right? So we had the 210, and we were at 29.9. Well, what if we were at 190, and we took that $20,000 deduction we were talking about before? Then calculate that. We don't go from 29.9 down to 25.5. So that's $4,500 worth of tax savings just by creating a deduction there. So, you start to play with the numbers, you start to get an understanding. And I'm going to be rolling out more tools over time about, okay, well, how do you actually do that? So, I'll tell you guys ways to do this. So one way is to implement an accountable plan. This is under section 162-2 of the code. And basically it's a reimbursement plan where your company reimburses you as an owner / employee for business use of your stuff that you're paying for out of pocket. So there's a lot of things that can be brought into an accountable plan. But basically, if you ever had a job where you had to give them a receipt, they gave you money, same exact thing. That's an accountable plan. And you just have to document how you used various things for business purposes. Another one is a summit strategy session where this doesn't apply to every business formation because you can't do it with Schedule Cs. But your business rents your primary dwelling from you as a for a business meeting, and we have a whole process where you create. There's a template basically of how to run your meeting, and then you look at your books and one, you'll actually look at your books. Two is you start looking at your business like a business owner does. So like these are some of the professional management skills that a lot of small business people are lacking because they just never went to business school, essentially. Um, but you want to. There's actually a process to looking at your records and figuring out how business is going. The vast majority, I mean, when I say vast, I mean 95+% of small business people, they wake up, they open up their app, and they say, "Oh, there's money in the account. Great." And they go out and do their thing. Or they open up their app and say, "Crap, there's no money in the account." And then they go out and they go hustle some more. So that's pretty much it when it comes to business analysis. What the Summit Strategy session does is it guides you through a monthly meeting. And so one, you have to have your books done, which you should be doing anyway, but a lot of people don't. And then two is like, well, how do you actually operate your books like a manager? How do you look at the trends in what is happening? How do you try to identify what's working and what is not working? Because at the end of the day, the whole purpose of the thing is just to do more of what is working, do less of what is not working, and then maybe experiment, in the margins and try to find new things that could work, right? And the Summit Strategy Sessions guides you through that and takes advantage of tax code under Section 280 AG subparagraph 2, um, and will give you a tax deduction at the same time because Congress will reward you for running a better business by having your meetings done, correctly. So, you know, as we start to develop these tools that we can distribute widely, because it's just running on our website basically, then people can start to use these tools to their own advantage and start to implement some of these tax saving strategies and going from 210 down to 190 very, very easily. So that's where we're starting to use technology to defund the government. Really, I want to get to $1 trillion rather than 100 billion. So I want to 10x this whole thing. But that's going to take more than just saving 20 grand a pop. That's going to take some multi-layer strategies, but can totally be done. 100%. Um, I just didn't have time to document like a 5-layer strategy because just prepping this, actually took me, about an hour. So I don't have all that time to be spending doing that kind of stuff. So yeah, so went to FinCon last week. It was a great conference. If anybody in the audience is into finance and creates content, it's a great conference. Next year they're doing it in Portland. I had never heard of it prior to getting ads past month or so, but it was here in Atlanta, so I was like, it's local, I'll go. I'm very glad that I went, and I recommend it for anybody who is a fit for that. But it has convinced me that we need to start doubling down on 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 defunding the government because that is the bigger mission. And as far as I'm concerned, that will make the world a better place. I know some people disagree with me, and that's okay. You don't have to agree with me. We can't save everybody from the mind virus, but for those of you who agree with that mission, then we're here for you. All right, so that took up half our time.
Okay.
I did want to get to some Q&A. So, Serena, what do we have? What do we have lined up for as far as questions this week?
So we have an investment question. So someone wants to know what's the best way to minimize taxes on investment gains?
Investment gains. Well, so depends on it depends, right?
Right.
Um,
Yeah.
so yeah, I mean, it depends on what the investment gain is, like how much it is, what type it is, what kind of asset it is. So let me walk through that for a second. Um, the simplest type of gains is just like selling a stock. So there are long-term gains and short-term gains. Long-term is I held the thing for more than a year. Short-term gains is I held it a year or less. So you definitely want to do long-term gains if you can. Basically, your tax rate will essentially be half of what it would be if it were short-term gains. And it could be zero if your total income for the year is like less than 50 grand or so. So that's thing number one. You want long-term, not short-term, because short-term just counts like any other income. Um, Thing number two is in the case of like a stock scenario, you want to look at tax loss harvesting. In fact, one of the people I met was a guy named Daniel at FinCon, and he is part of a company called FREC, FREC. And they have a kind of amazing, is it FREC.com? Yes. So these guys have a really amazing platform that I'm looking at, and I've got a call with them later on, I think next week, where what they do is they will do direct investing and tax loss harvest along the way. And what I mean by that is that let's say you want to buy the S&P 500. Now, there are many ways to do that. You could go out and you could buy an index, and you could go out and buy an ETF. You could go out and buy a mutual fund. All of these have the S&P 500 inside of them. Or you could buy 500 stocks. That gets difficult, but it's actually the best way to do it. So the reason it's the best way to do it is because there's no management fees if you are doing your own investing, and then if you get the dividends, you can decide how to treat that. What these guys do is they do direct investing to get you that index. So I think they have like 20 different indexes or indices that they can mirror. And then along the way, what happens is each day or like multiple times a day, it'll actually check each stock against your cost basis. And if it's down by a certain percentage or more, it will actually sell that stock at a loss, and then it will replace it with a stock that is not in that index, but is in the same sector. So let's say, like McDonald's got hit last week because this E. coli outbreak, and it was down 10%. So let's say you took advantage of that, you sold the McDonald's stock for a loss, and you replaced it with Burger King. So that would be an example of a swap. Now, what that does is that gets around the wash sale rule, where, if you sell something and then buy it back within 30 days, it basically is like the sale never happened. They just discount it entirely. So you have to be out of that stock for at least 30 days before you buy it back uh, in order to solidify that loss. However, if McDonald's is down 10%, you don't want to miss out on the rebound, right? So you want to have something that's in the same ballpark but not the same, so that you can get some of that same price exposure. And so I was talking to these guys, and they were saying essentially, when they go through this strategy, your net position on the index is within 0.1% of the index if you held it, perfectly. But at the same time, you're building up all these tax losses along the way, so that when you do sell and when you do have those gains, you have those other losses carrying along that will offset that gain. So that would be an example of a strategy. That's a longer term strategy because it takes time for those losses to build. But when you think ahead, you can start to do things like this and save yourself a giant amount of money in taxes if you're a heavy stock investor. So that's if it's stock, though. Well, what if it's real estate? Well, if it's real estate, then you can look at installment sales to spread out the impact of the tax over time. You could look at 1031 exchanges, which is completely tax free if you roll over all of the proceeds, and then as long as you keep that money at work investing in real estate, then it's tax free, and you can do that again and again and again, as long as you keep the money working in an investment. That's one of these incentives that is created in order to have real estate investors provide housing for people, essentially, or provide commercial space or what have you, but primarily housing. And so, that's a tax-free strategy. It works perfectly. If you're selling a business, it's like, well, are you selling business assets? Are you selling business stock? It depends. If you're doing, there's all different kinds of things you can do when you're selling your business. So if you have employees and they have an employee stock ownership plan, you can sell to that plan so that your employees start to own the business directly, and that could be a tax-free sale for you as the owner, or as the full owner. You can do a 1202 sale, where if you have founder stock, the C corporation, and you sell the stock, you can get up to $10 million of gains tax-free. If you're doing an asset sale, which is more common in the small business space than stock sales, then you can start to do installment sales and all these kinds of things. So there's lots of tax strategies that are involved the in investments, but it depends very much on what type of investment it is, what kind of sale it is, how long you've held the thing, and all these different things. Um, there's also the pure version of, you sell something, let's say it's stocks, you have a big gain, and then you take that and you invest it in, um, active real estate. So, short-term rentals or something that you spend a lot of time on. And you cost segregate that property and you get a massive tax deduction in the front year. So that's not reducing the capital gains tax, but what it is it's adjusting your entire uh, tax position for the year, and it's going to lower the overall thing. Because it doesn't really matter if this thing is tax free or that thing is tax free. What you care about is the total amount of tax at the end of the day, right? So it's so yeah, it's I could go on and on, and but I won't. But fundamentally, it depends. But the basic factors that it depends on is how long you've held it, what kind of thing it is, and what kind of sale you're doing. So those three things. Does that you feel like that actually answers the question?
Yeah, that was pretty good.
Okay.
Awesome, awesome. So we have a business-related tax question.
I can barely hear you.
Oh, I'm sorry about that. So we have a business-related tax question. Someone wants to know how should they handle their estimated quarterly taxes, and is this necessary to file taxes if they're a business owner?
Okay, so I'll do the last part first. Is it
Okay.
necessary? Is it necessary? No. So what happens if you don't is that you get an additional tax at the end. So it depends on the interest rates. Right now it's about 8%. So let's say you owe $10,000, you didn't make any estimated payments, so you saved it all up for April, and the IRS says naughty naughty. You were supposed to do that. You got to file Form 2210, which is just part of the tax return, and we're going to charge you $800 on that 10,000, roughly. And so that's what happens if you don't do it, and you pay a little bit more. So when I when I explain that to business owners, the majority of the time, they have things to do. So they don't want to have money sitting in an account at the IRS. Some do. Some like that security, but most business owners are a lot more aggressive than that. And they'll say, it's like, well, I'd rather use the money myself and I'll pay the extra at the end. It's like, well, okay. Just be aware that that's what's happening. And sometimes they get themselves into trouble. And it's like, well, you shouldn't have blown all your money and got yourself into tax trouble. Uh, there was, you know, no names or anything, but one client came to us recently, um, has a huge day job income, like several, mid six figures basically, and no tax withholding because I don't know why. And they said, it's like, well, we couldn't afford to pay the taxes. I was like, yeah, I don't think that's true. But the IRS certainly won't think it's true because we talked about doing an offer in compromise. And what an offer in compromise is an offer that you're making to the IRS and you're saying, hey, I have this tax bill, I can't pay it. Will you compromise? And there's a formula for that. It's not just a win, right? It's there's a formula where they list out your income, typical household expenses based on family size, how much equity you have in your house, how much equity you have in bank accounts, and all these different things. And it comes to a number at the bottom. And if that number is greater than the tax, then they will not accept an offer to compromise. If that number is less than, and it's spread over a certain payment schedule, then yeah, they might take it. And it takes 6 months and it's a whole thing. But very, very rarely will people actually be able to successfully get an offer in compromise accepted. So it's just one of those things. So if you are in a position where you're going to have a tax liability and you decide to wait on it and pay the extra later on and pay that underpayment penalty, which is what it's called, then just be very careful. That's my advice. Be very careful. Don't blow the money that would have gone towards the taxes because that's not what you want. You don't want to get the nasty letters that I got. It's not fun. Um, so that's if you don't pay it. If you do pay it, then that's fine too. If you're self-employed or the equivalent, like you own your own S corporation or partnership or something, and your income is variable, what you want to do is you want to project to actual. So there's two different methods. One is you look at last year's amount and you say, okay, as long as I pay at least that plus a little bit more, then I'm good, right? So if last year my taxes were 10 grand when all was said and done, as long as I pay 11 grand this year spread out over 4 periods, then we're upset as far as penalties go. Now, that may or may not be the right number, though, because you're just projecting on last year. This year is different. So maybe you still end up with a balance due at the end. Maybe you get a refund. It just depends. Depends on how the years went. So what I prefer is to actually do a projection quarter by quarter and making estimated payments based on that. So, well, I'll show you. So one of our tools is the Trailblazer Toolkit. And if you're in the Navigators group, you get this as for free. So let's say we are in we're in October right now, right? So October's actually ending. So let's say each month we have $5,000. Just picking numbers, right? So that's 50 grand altogether, right? And we got to fill this up a little bit. Married filing joint is fine. And the way this worksheet works is we're assuming it's an S corporation. And so we go to our personal projections and it says, well, in October, well, September would have been the last one. That would have been the last quarter. And it would have said that our projected tax load based on this is $6,200. And now you have to ask yourself, it's like, well, am I caught up to $6,200? Well, let's say I paid 500 here. Say I paid 600 in February. Let's do that. Say I paid 100 in March, 200 in April, 700 there, 300 there, and so on. So there's something wrong with this formula. Okay, so I'm up to $2,400. So this is 2,400, and this is I'm trying to get to 6,285, and so that is not going to get me there. So I got to start picking up the pace. I started. Let's just do 700. Not 700. 700. 700. 700. Now I'm at 4,500. Okay, we're getting close to our $6,200 total. So, if you do these actual projections, you can start to hone in on exactly what your tax liability would be so that by January 15th, when you make the last estimated payment, that you actually are right on target with what you are done because you've done these pro forma projections throughout the year. So that would be the better way to do it. So those are your three basic options. Don't pay them, take the penalty, pay them based on last year's numbers, or do the actual projections quarter by quarter and project as well as you can. So, the difficulty with doing the projections is you got to do a pro forma tax return. And that's kind of what we're doing here under a certain set of assumptions that is pretty common to our clientele. So, it's complicated, but it's the vastly more accurate way to do it. So that is how you do quarterlies. One of those three things.
Yep. Or you can come see us and we can help you.
Or that, yeah, we can do that for you.
Yep. So we have an education question about the 529 plans. Someone wants to know how does 529 plan work? How do they work? And what are the tax benefits involved?
Yeah, so the tax benefits on a federal basis, the tax benefits are that when you use that money for college stuff, the investment gains are tax-free. Okay, so it's kind of like a Roth IRA where you put money in, put money in, put money in. You don't get any deduction when you're putting money in. Then it's invested in something, and there's different plans that do different things. And um, and then when you use that money, hopefully there's some sort of appreciated amount, and you do not pay taxes on that appreciation. So that is that's the basic idea of how it works. Now, some states will give you a deduction at the state level for a contribution to a 529 plan, but that's going to vary state by state. Now, how they actually work is there's two basic kinds. One is where you are doing an investment style where you're putting money into a special account, you're taking the money in that special account, and you're buying stocks, bonds, whatever. It's usually a fairly limited list, but you can buy different investment opportunities. The other type of 529 plan is a prepaid plan, like Florida prepaid is one of these, where basically they're saying, okay, if you are a Florida resident, you have a kid in Florida, and you want to prepay for a Florida college, we're going to give you a price that's now based on however long it's going to be between now and the expected time of college, and you can basically lock in your price now, and they're guaranteeing that they will cover whatever package that you choose. So like in Florida prepaid, you can get like a 2-year plan or a 4-year plan, or you can add meals and housing, or you could just do the books and tuition, stuff like that. So there's different options, but they're saying you are pre-purchasing this particular package, and if you go to a non-Florida school, we will pay the equivalent to this other school on your behalf. So you're not losing out in that kind of scenario. So that's how they work. And then if you don't use them for education, and the beneficiary, which is the child, ages out of the program, then basically it kind of converts to an IRA, sort of. So there's that's the basic idea. So when it comes to the money you're putting in, by and large, not a tax deduction, but when you take the money out, also not income. So that's the primary benefit.
Okay, awesome. So we have a audit question.
Okay.
Client wants to know what common mistakes do people make that could trigger an audit?
A lot.
A lot. Yeah, I was gonna say a whole bunch of those. Yeah.
So there's different risks, there's different factors that can cause audits, and none of them are guaranteed. It's just, creates risk elements, right? So the biggest one is just income. And the higher your income is, the higher your chance of audit is. So you have a roughly 0.5% chance of getting your name picked out of the hat just randomly. But as you make more money, that number goes up. And if you get over like $1 million, it's kind of last time I saw statistics on it was about 5% chance. So that doesn't mean that you will get audited, but it just increases your risk. So then there are things that will, so that's just kind of across the board. Then there are specific issues that will increase your chance of audit. So one is if you do things that on the face of them have problems. So one is unreimbursed partnership expenses. This used to be used all the time. In fact, when I reviewed Donald Trump's tax returns and they got leaked, he had used unreimbursed partnership expenses. So basically, it's exactly what it sounds like. It's saying, hey, I'm in this partnership. I paid for this thing out of pocket and I didn't get reimbursed. So I'm taking it as a deduction on my itemized expenses, on my itemized deductions. And that is allowable if it is spelled out that that is how it's being treated in the operating agreement of the partnership, which nobody ever does. So the vast majority of UPEs, as they're called, are not legitimate because they don't follow the rules. So the better way to do that is just get reimbursed from the partnership, and then it becomes a deduction at the partnership level instead of at the personal level, and you don't have to deal with these things. And that's an accountable plan, like we talked about earlier. So if you're in a UPE, or if you have UPEs on your tax return, and it'll be abbreviated that way, it'll say UPE on the Schedule E, page 2. If you have one of those, that's an audit risk. If you are in a conservation easement, whether directly or indirectly through a conservation easement fund, it's an audit risk. And not because you did anything wrong, but just because other people did and they, made it bad for you. And so they got themselves on what they call the dirty dozen list. So people have a well, most people have never heard of it, but the people who do have heard of the dirty dozen list, they get very skittish about it. And it's like it's not that these strategies are illegitimate; it's just that other people have abused them, so you got to be careful. That's all. Um, you just follow the rules. It's very simple. uh, another audit risk is mileage on Schedule Cs. And I have seen people come in with crazy numbers on their Schedule Cs, showing that, I drove 100,000 miles last year for work, for my little small business. It's like, really? Did you? One, do you have records of that? Well, no. Two, that's like whatever 1,000 miles a day, whatever the numbers work out to be. And yeah, there's like three people that actually do that, but for everybody else, no, that's not what happened. Um, so that's a big audit flag. Um, things that don't match is pretty much a guaranteed audit. So you know, so there are these information reports. So 1099s, 1098s, W-2s, these are all information reports that are provided to the IRS by third parties. And so if your tax return does not match what the other people, the third parties reported in their information, then you're going to get a letter, almost certainly. And what level of letter varies depending on the thing. But at the very least, you're going to get, hey, you didn't include this, pay us, right? At the very least. Other things that are audit risks are there's out and out scams that are out there, like the federal fuel tax credit scam. So if you buy gasoline or diesel, and inside of every gallon that you pay, let's say, right now at the pump it's about $3, at least where I am. If you're in California, I'm sorry, it's like five whatever or $6, almost twice that. So where I am, it's $3 a gallon. Inside of that, there's a percentage of that is federal tax, and there's also state tax in there. But the federal tax, if you then use that gasoline and use it in like off-road construction or charitable purposes or things like that, then you can get a rebate on that tax that you paid because you didn't use it for use on the roads that are supported by whatever the national highway system. So the feds have a credit where you can get that money back on your tax return, and you just say, hey, I used 3,284 gallons of fuel, and at whatever the tax rate is per gallon, then the federal government owe me so many dollars on the back end. So this has been going on for decades, where people just put in numbers there, and and
True.
and it's like at this point in time, so people used to get refunds out of this, but at this point in time, that is pretty much a guaranteed audit. And it's just don't do it. So it's like I said, 99% of the time, the people who claim this are not legitimately claiming this particular credit, and then they will get audited as a result. So there are, I mean, and I could go on, but there are things that don't make any sense because on a tax return, what you're doing is you're telling the government, hey, here's what happened this year in numbers, and I'm explaining to you, the federal government, the character of the different numbers that I had, and so and based on that situation, my tax liability is this. And then it's up to the government to do an audit. And an audit is just asking questions. So say, okay, let's prove that. That's all an audit is. Now, how easy that is to prove or not depends on a lot on who you get as far as an auditor goes. And the vast majority of the time, what the IRS is, gets people on, quote unquote, is documentation. They say, okay, you claimed 3,824 gallons worth of fuel for a federal fuel tax credit. Show us your proof that you did that. And most people can't come up with the proof, and that's the problem. So, you know, in IRS speak, an audit is a tax examination. So they're examining the return in detail, and they want to see the corresponding documentation that proves or supports the numbers that were reported on the tax return. So, so as long as you can do that, then you will win an audit. How painful it will be depends in large part on who you get as an auditor. So, I'm of the opinion that you should take every last deduction you are entitled to, um, and minimize your situation as much as possible. At the same time, I understand the people who are more skittish about it and say, well, if this is going to increase my risk of audit, I don't want to do it, even if I'm entitled to it, because I just don't want to go through the hassle. I get it. It's a decision that everybody has to make as far as what is their personal level of comfort with things. But yeah, so when you're explaining that story to the government, you have to ask yourself, does this story make sense? If no, it's a problem. That's kind of what it comes down to. If yes, then it probably goes right through. So that is that's the basics behind audit. I mean, obviously you could dive down into that as deep as you wanted to go. Uh, in the old days, I had this client who had moved from New York, and he ran a like a little clothing store in New York, and he was like as aggressive as he could possibly be, and he had a whole strategy for dealing with audits, and so he would call somebody, and then he would get this letter from the IRS, and it said, call the office, and set up an appointment, and he would make the appointment for like 4:30 on a Friday. And because he knew when he went into the office that the guy across the table from him didn't want to be there. Weekend's coming up, he wants to go out the door, right? So let's wrap this up as quick as possible. Flip through the papers as quick as you can and get out of there. Um, and then he would always strategically leave some documentation at home. It's like, oh, I forgot that. We'll have to reschedule, and try to play that game again and try to get somebody else as an auditor. Uh, these days that doesn't these days that
I'm
doesn't work
laughing
as
at that.
well, because they don't really do in-office audits anymore. It's more correspondence audits, so basically just letters back and forth. Um, but that was a funny strategy back in the day when that applied. So I'll tell you one quick other audit story. So my dad got audited. This is before I get into taxes at all, and because he was doing weird stuff. I ended up looking at what he was doing. I was like, yeah, I don't know, that's a little odd. But so he gets audited one year, and he's retired and he's got nothing better to do, so he goes down to the office, right? And he's got a binder. I remember in our house in the laundry room, there was like this little built-in kind of desk area, and on the top shelf there were just these binders, and the binders were all of his old tax returns going back to 1970 something. So for the audit, he goes in and he brings all those binders of tax returns and he sets them on the table. And it's a stack like 6 feet high or something. And he says, you know, you've accepted this, thing that I've done for whatever, 30 years, 40 years, whatever it was at that point. Why is this one a problem? And the auditor just looked at him and says, okay, just go home. It's just like, this is too much work to argue with this crazy guy who has too much time on his hands. So, yeah, I mean, it's all about who you get as far as dealing with the auditors and what you can bring to bear. Fundamentally, they're just asking for documentation. It's like, okay, do that. Have the documentation, do all the things, have the paperwork, have the paper trail, and be able to demonstrate it's like, well, this number comes from this place over here because of X, Y, and Z. And if you can do that, then that's it, and you'll be able to win an audit. But again, not going to be pleasant, just because the process is the punishment in those kind of cases. All right, so that brings us to the end of the hour. We will do this all again next week, and if you have ideas for what we should name the show, as far as defunding the government, let me know. Email office@taxsherpa.com and put in your suggestions. Or if you're in the Navigators or Explorers group, you can put them on the board, and love to hear from you. All right, but that's it for this week. We'll do it again next week. 6 p.m. Eastern, Tuesday, whatever November, that's going to be November 5th. Oh, it's going to be election day. That'll be fun. Maybe we'll do some live streaming election coverage and see what that means for taxes.
Yeah, let's do it.